Welcome back to Learn SKN, and today we have another economics video for you, another CSEC economics video for you. So the last video we looked at section 5, and we were looking at money. And so we outlined how money came to be, we outlined the bartering system and the problems inherent in the bartering system and why money was needed. We also outlined some of the characteristics of money and also some of the functions of money. And so today we're going to continue along that path. We're looking at money still, but today we're looking at section 5, but we're looking at specific objective 4. Explain the concepts demand for money and money supply. So demand for money and money supply. So the demand for money. Now this one is more literal than when you're looking at supply and demand. Now this is simply, why do we need money? Why do we hold money? There are three main motives as to why people hold money, as to why we hold money. Three main motives, and they are the transactionary motive, the precautionary motive, and the speculative motive. And just by the words alone, it's somewhat self-explanatory. But we're going to still look at them separately so we can understand what each motive entails. Then we're looking at the money supply. What is the money supply? The total stock of money in the economy at any moment. And then we're looking at the supply of money in terms of M0, M1, and M2, and what all that entails. And so if we were to jump into section 5, it might take a while because we have to look at the role of the central bank. We're going to do that in a separate video. Right? So today we're going to have a shorter video, but we're just focusing on the concepts of demand for money and supply for money. And I promise you, at this level, we are not really looking at any charts or graph. Okay, we're not really looking at any graphs or charts, so don't be scared for that one. All right, so the money supply, as we said before, the money supply is the total stock of money in the economy at a particular time. The supply of money in the economy is determined by the central bank. The money supply can be defined in terms of M1 and M2. So that's M1, M2. So M1 is the narrow money and M2 is the broad money. But there's also M0 that we're going to look at later on. Now, what is the difference between M1, M2, M0? Now, M1 can be considered as narrow money. M2 is considered as broad money. Now, how are they different? So, if you're looking at the supply of money here, measuring the supply of money, M0 is equal to the coin, currency, physical paper, and the central bank reserves. That alone is what we call M0. That's the narrowest type of money. That's M0 is equal to the coin, currency, the physical paper, and the central bank reserves. So all those make up what we call M0 money. Now a lot of textbooks don't really follow M0 money. That's why this textbook doesn't have it. You only start from M1 and M2. But since this syllabus asking us to say what M0, M1, and M2, what they are, that's why we go and look at it from a next source, not the textbook only. Okay, so yeah, so M0 is just the currency, all the currency, the coins and the paper, and also the central bank reserves, and that is also all the coin and currency that the central bank has in reserve. So it's all the coin and all the currency, the physical paper, the physical coin, and the central bank reserves is all the actual money itself, the ones that has been minted. That's M0. Then we have M1. What is M1? M1 consists of assets that have liquidity. Liquidity means the ability to be easily converted to cash. So if they say something is very liquid, that means it can turn to cash very, very quickly. For example, you have a check, very liquid. Cash, easily converted to cash. But if you have, let's say, a car isn't very liquid. You have to go and find somebody to buy the car, and it might take a while. It's not very liquid. But a cash, you go cash it right there, liquid. So liquidity refers to the ability to be converted into cash quickly. So the faster something can be converted into cash, the more liquid that is. So when you hear companies saying they're going to liquidate, that means they're going to sell everything for cash. Break it down. So M1 consists of assets that have liquidity or the ability to be used as or easily converted into cash. Components of M1 include all currency, traveler's check, and demand deposits. So M1 includes all of MO, M0, which would be the coins and the paper, plus the traveler's checks and the demand deposits. Those are the money that you put on your account. The demand deposits are the monies in checking accounts. So that's what we're talking about, the demand deposits. So whereas M0 is only the currency, which is the coin and the paper money, the M1 contains all of that, the currency, in addition to the traveler's checks and demand deposits. And demand deposits are all the money in a checking account. So that's M1 right there. So that's narrow money. Then you have M2. What is M2? Now, M2 consists of all that is found in M0, all that is found in M1, plus deposits in saving accounts and money market mutual funds. So a money market mutual fund is a fund that pools money from small investors to purchase government bonds, government or corporate bonds. And so the overall thing is called a money supply. So M2 contains M1, M0 plus deposits in savings account and money market mutual funds. And the money market mutual fund is a fund that pools money from small investors to purchase government or corporate bonds. And so those are the measuring the supply of money. So let's look at the textbook a little closer and see what they continue to say here. So money supply. Remember I said that the textbook did not really look at M0, but we look at M0, which is just the currency, the paper, and the coins, and also the reserves in the central bank. Now narrow money, again M1, narrow money. M0 is in narrowest money, but M1 is narrow money also, and M2 is what we call broad money. Now M1, notes and coins, plus checking deposits, plus traveler's checks. M2 contains all of M1, plus saving deposits and money market accounts. Narrow money is called M1. This narrow money can be used directly for transaction. It consists of all notes and coins in circulation, all deposits on which checks can be drawn, and traveler's check. And that's M1 or narrow money. So that's the definition right here for M1 or narrow money. Consists of all notes and coins in circulation, all deposits on which checks can be drawn, and traveler's check. So that's M1 or narrow money. Now M2 or broad money consists of all of those, right? Plus saving accounts in the financial institutions and money market accounts. So all those plus M1 and M0 is what we call M2 or broad money. Broad money, called M2, consists of M1 plus savings accounts in the financial institutions and money market accounts. Saving accounts and money market accounts are considered part of broad money. As such, savings can easily be converted into cash or transferred to a check account to be used as money. All right, so that's basically it for the supply of money. You understand the measuring the supply of money. And so the overall money supply is all the money in the economy at a specific time. And that would have covered this aspect of the syllabus. Money supply, the total stock of money in the economy at any moment as a definition. Supply of money in terms of M0, M1, and M2. Now let's look at the reasons why we demand money. Money demand. Right? Why do we demand money? So the demand for money. 3 motives for demanding money. So there are 3 motives for demanding money, as I said before. So you have the transactionary motive, the precautionary motive, and the speculative motive. Now what is the transactionary motive? Again, very much self-explanatory. Transactions. You have to conduct transaction in your daily life. And what's the engine for conducting transaction today? Money. It's not barter anymore, it's money. So the transaction motive for demanding money arises from the fact that most transactions involve an exchange of money. So to do your day-to-day going, you go to the shop, you exchange money for goods. That's a transaction. You jump on a maxi, taxi, a bus. You exchange your money with the driver. That's a transaction. So your whole money, you demand money because you need to carry out transactions day to day. Every day you have to carry out certain financial transactions and you need money for that. And so that's why the demand for money comes from the transactionary or the transaction motive. You are motivated to demand money because you want to carry out various transactions, small and large, in your day-to-day existence. Then you have the precautionary motive. Again, precaution. People often demand money as a precaution against an uncertain future. Unexpected expenses such as an emergency. So now you have to hold money because you don't want to be left, holding the bag. You want to know if an emergency arises, you have money to take care of that. And that is why persons have savings accounts, because you want to make sure you have money at hand just in case something happens. Your car breaks down, you have to fix that one time. You break a hand or something, a medical emergency, you want that taken care of one time. So you never know what could pop up, just pop up. So you're going to demand money just for that precautionary measure, just in case something happens, you have the money on you. So that's another motive for demanding money, just in case, for a precaution. And so that's the precautionary motive for holding money, for demanding money. And then the other one now, the last one we have here, is the speculative motive for demanding money. And the speculative motive for demanding money arises in situations where holding money is perceived to be less risky than the alternative of lending the money or investing it in some other asset. So what they're saying here is that you might think, okay, so you're speculating. You might say, okay, something might happen tomorrow, next year, in the next 3 months. So I need to hold on to my money for when that happens. So they say when holding money is perceived to be less risky. So money in hand, you have money in hand. It's less risky than to just take all the cash and put it down in a fixed deposit and you can't touch it, or invest it in a bond or a stock that you can't be able to use for cash one time if something happens. So for example, if you're going to say, okay, hurricane might be coming, so you're speculating that hurricane would come at a certain time in the year. We're in the Caribbean, we know this. And so something might happen, roof might get blown off, things might go down. So you want money in hand just in case something happens. So you're speculating that it's more risky, it's less risky to have money in your hand than to invest it somewhere or to buy some other asset. So that is what the speculative motive for demanding money comes from. The situation where holding the money is seen or perceived to be less risky than the alternative of lending the money or investing it in some other asset. So they're saying that you'll be perceived that holding cash in hand, having it under your pillow, having it close to you in your account somewhere, but right there at hand, ready to grab. It's less risky than if you invest it in something that might crash later on, or you speculate that an investment might be bad. So you say, I'm not going to put my money in this market. I'm going to hold on to it. Things like that. So those are the 3 main motives for demanding money. And so we looked at the supply measure of money and the demand for money. And of course, as you go further on into economics, you're going to learn a lot more about the supply of money, demand for money, all those things. But for now, on the high school level, you just got to know what, measuring the supply of money, M0, M1, M2, and then just the motives for demanding money, which is the transactionary, precautionary, and the speculative. So those are the reasons, the motives for demanding money. And so basically, that's it for subsection 4 in section 5, our specific objective 4 in section 5 of the CXC economics syllabus. So we got that. So in the next video, we're going to be looking at the role of the central bank. But of course, you are not going to know when that video drops unless you subscribe to the channel and hit that notification bell so that you know when the next video drop with the role of the central bank. And let me just say, I did a video similar to this for POB. We will look at the role of the central bank, but I'm going to do it over again. It's going to be that is why you can do POB and economics. You can just use some of the content from POB and for economics, and you can pass the subject just like that. But there are some things that it can go deeper in depth with, or something that just cover that POB doesn't cover. So this is one example: money and the role of the central banks and other financial institutions. These things are cross-pollinated, so you can use the information from one for the next. But I'm going to do over next video for the role of the central bank. Okay, so make sure you stay tuned for that one if you're an econ student. All right, so that's it for now. Thanks for watching. Thanks for listening. Quick, short video.